Charlie, tell them about the one you missed.
Well, I have two investments that come to mind. When I was young and poor, I spent $1,000 once buying an oil royalty that paid me $100,000 a year for a great many years. But I only did that once in a lifetime. On a later occasion, I bought a few shares of Belridge oil, which went up 30 times rather quickly. But I turned down 5 times as much as I bought. It was the dumbest decision of my whole life. So if any of you have made any dumb decisions, look up here and feel good about yourselves.
Yeah.
If there is one thing I want you to remember from this video, it's this. Charlie Munger made 30 times his money on his worst investment decision. How is that possible? And what can we learn from it? Stay with me until the end of this video to find out. This is Lunch Investing. Charlie Munger explains the Belridge oil story in further details in the 2001 meeting. Now, let's hear it from him before we go on to my comments.
Good morning, gentlemen. My name is Jay Parker. I'm from Washington State. And this question regards mistakes. So that being the case, it should probably be directed to Mr. Munger. Mr. Munger, I know you're fond of evoking humility to promote rational thought. So my question is, what's the most recent business mistake that you've made, Mr. Munger, and why did it occur?
I'm going to take notes on this one.
The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs. But, Warren, we have blown
billions and billions and billions. I might as well say it.
Right, right. And we keep doing it.
Some might say we're getting better at it.
I don't like mentioning the specific companies because we may in due course want to buy, do so at our price. But practically everywhere in life and in corporate life too, what really costs in comparison with what easily might have been are the blown opportunities. I mean, it's an awesome amount of money. When I was somewhat younger, I was offered 300 shares of Belridge oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it. The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it.
Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And And they're really, I mean, we have been thumbsuckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little, and we waited around hoping we would get more at the price we originally started. There can be a lot of things, but those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook.
Charlie Munger is widely regarded as one of the smartest and most successful investors of all time, and I fully agree with that. But even he admits that he made some dumb mistakes in his investing career, and the biggest one of them was his investment in Belridge Oil. Let me tell you what happened. In 1977, Charlie Munger bought 300 shares of Belridge Oil at $115 per share. He spent $34,500 on this investment. A few months later, he got offered another 1,500 shares at the same price of $115 per share. But this time, he didn't have enough cash to buy them. He would have to sell some of his other stocks or borrow money to do so. He decided to pass on this opportunity. He thought it was inconvenient to liquidate his other assets or take on debt. He didn't want to mess with his portfolio. He didn't know that he was making the dumbest decision of his life, according to his own words. 2 years later, in 1979, Shell bought Belridge Oil for $3,665 per share. That is 30 times more than what Munger had paid for his 300 shares just 2 years ago. He made a 30-bagger in just 2 years. That is an incredible return by any standard. But he could have made much more. If he had bought the additional 1,500 shares, he would have owned 1,800 shares of Belridge Oil, which would have been worth $6.6 million after Shell's acquisition. That is a huge difference. And that is why Charlie Munger calls this his dumbest decision. Because he missed out on a once-in-a-lifetime opportunity. Because he let his fear and inertia get in the way of his judgment. Because he didn't bet big on his highest conviction idea. So, what can we learn from this story? I think the main lesson is this. The difference between betting big on the companies that you have the most conviction in and spreading your money across many stocks can be enormous. Let me show you an example. Let's say you have a portfolio of $100,000 and you run that portfolio 10 by 10, meaning 10% allocations for 10 stocks. And for clarification, this is not the structure of my portfolio. I have over 50% conviction on my biggest position, and my top 3 positions make up 78% of the total portfolio currently. But to make it easier, let's say a 10 by 10 portfolio, and one of the 10% investments is the initial investment of Belridge Oil. And on average, the stock market returns like 8 to 10%. So to make it easier, let's say the other stocks return 20% in the 2 years following the initial investment to Belridge Oil. Here's what would happen in this scenario. Your initial investment of $10,000 in Belridge Oil would become $300,000 in 2 years. That is a 30-bagger, just like Charlie Munger. Your 9 other stocks would each grow from $10,000 to $14,400 in 2 years. Your total portfolio would be worth $408,000 in 2 years, which is amazing. But what if you had followed Charlie Munger's example and invested 60% of your portfolio in Belridge Oil instead of 10%? This scenario assumes that you bought the additional 1,500 shares, so if 300 shares is 10% of the portfolio, 1,800 shares would be 60%. Here's what would happen in this scenario. Your initial investment of $60,000 in Belridge Oil would become $1.8 million in 2 years. Your other 4 stocks would each grow from $10,000 to $14,400 in 2 years, just like the first scenario. So your total portfolio would be worth $1,848,000 in 2 years, which is just mind-blowing. As you can see, the difference between the two scenarios is huge. By betting big on Belridge Oil, you would have made more than 4 times more money in just 2 years. You would have turned $100,000 into almost $2 million. That is the power of conviction. That is the power of betting big on your best ideas. So, as you can see, the difference between betting big on the companies that you have the most conviction in and spreading your money across many stocks can be enormous. But I also want to say that you should do what works for you. You should be invested in the things that allow you to sleep well at night. If you don't feel comfortable with having 60% of your portfolio allocated in a single company, you may not have been able to sit on this position until Shell bought it for 30 times your cost. However, according to Charlie Munger, the money he made on Belridge Oil went into his investment in Berkshire Hathaway. And in the 2001 meeting, he said that it has cost him $200 million to that day. If you trace that even further to today, the total cost is at billions of dollars. This shows that even the best investors can make mistakes and miss out on opportunities. But it also shows that they can learn from their mistakes and move on to the next big thing. That is what I try to do with my own portfolio. I have over 50% conviction on my biggest position, and my top 3 positions make up 78% of the total portfolio, as I said earlier. I have done extensive research and analysis on these companies, and I have strong reasons to believe that they will deliver exceptional returns in the long term. So I hope you enjoyed this video and learned something new. If you like the content, please subscribe and ring the bell so you won't miss my future videos. If you have anything to add, please let me know in the comments. I try to answer them as much as I can. That was it for today, and I'll see you in the next one.